Hi guys, Ricardo here, Business Management Lecturer, and today we're going to look specifically at BMG 5112 and in particular the chapter on financial management. Now, when we get into this chapter, how does financial management and business management kind of tie in together? And if we look at the business management functions, what does it really entail? Well, predominantly it is 4 functions: planning, organizing, leading, and control. This control element is really where the financial management element comes in. So what is financial management really? Well, financial management is really about kind of looking forward. How do I as an organization provide information to the management of the organization which will enable them to make strategic decisions going forward that will enhance and benefit the organization? Yes, from an accounting perspective, we're looking at historical data, stuff that have happened in the past. So that we say backward looking. But financial management is really about forward looking. How do I make decisions that will enhance the performance of the organization? So here's the scenario. Imagine you've started up a business, and what would be some of the things that you would have had in your business? Well, initially you would have probably had some startup capital that you would have put into the business. You would have bought stuff with this. Things that you would have: a delivery truck, a factory perhaps, money in the bank account, inventory, be it raw material. Imagine you making couches. You would have wood. You would have hopefully customers that you've sold on credit. And then you would also have things or people that you owe money to. You could have bought your factory, but you don't necessarily would have paid for it. You would have a bond on it. You would have had a wood supplier, but you haven't necessarily paid them yet. You've bought on credit terms. So you would owe them the money on these. And naturally, hopefully you have some profits from previous years, which would also be sitting in your business and utilizing these profits to go forward. So let's try and conceptualize this in a little bit more logical sense. What do we mean by all of these things that we have? Well, these things that we have are actually referred to as assets. The things that we owe people, well, they're actually liabilities. And the money that we've invested into the business, the profits that have come from the business, well, that is the equity of the business. If we talk about assets can be broken down into 2 categories. Kind of long-term, or what we refer to as fixed assets. That would be your factory, your delivery vehicle, and so forth. And then also your current assets. Now current, we mean in other words, that it could be converted into cash within a 12-month period. Current assets are made up of the money in your bank account, debtors, in other words, sales that you've made on credit, and also inventory. When we talk about equity, well, equity is the share capital, in other words, the investment that the owners have put into the business and the retained profits from the business. The liabilities, again, can be broken down into long-term and short-term or current. Current would be things like the accounts payable, in other words, suppliers that we owe money to, and also short-term portions of loans or overdraft facilities. Long-term would be kind of bond repayments and so forth. Broadly speaking, there are 4 categories of ratios that we can look at. And let's look at these categories now. The first category is what we refer to as liquidity ratios. The second one we refer to as solvency ratios. The next we can look at profitability ratios, and lastly looking at measures of economic value. We spoke earlier about looking at the liquidity ratios, and under the liquidity ratios, the first ratio that we can look at we refer to as the current ratio. The current ratio is current assets divided by current liabilities. The general rule of thumb here is that we want to get a ratio of at least 2 to 1. In other words, for every 1 rand that I owe a supplier or my current liabilities, I have 2 rand available to pay that R1. If I look at the second equation, the asset test ratio is current assets minus inventory divided by current liabilities. The reason why we exclude inventory from the asset test ratio is that inventory is the least liquid current asset. What we mean by this is that it is the longest to convert into cash. In other words, I would first need to sell my inventory on credit, then collect the money from my debtor, and only then will I have the money in the bank where I can convert into physical cash. The issue with inventory as well is that there are risks associated with inventory. Inventory potentially may be perishable. It can also be damaged. It could also be stolen. And therefore, we would like to exclude inventory from this calculation. The general rule of thumb here is that we would like to have a ratio of a minimum of 1:1. This would mean that for every R1 that I owe somebody, I have R1 available to give them. In other words, my business would still be in business or afloat as a result of still having cash available in the business. Let's look at the next equation, looking at solvency ratios. And with regards to solvency ratios, the first ratio there, we look at the debt ratio. Looking at the debt ratio, this measures the percentage of assets that are financed through debt. In other words, the ratio would be total debt divided by total assets. This is important to understand this ratio because we may have borrowed significant money to finance these assets. And that could be problematic because with debt comes interest payments. So we are in essence putting financial strain on the business because we have a legal commitment to banks to repay not only the capital principal amount, but also interest over a period of time. And therefore you would want to minimize this. A lower percentage is favorable, and therefore the debt ratio should not exceed more than 50%. The second solvency ratio that we look at, we refer to as the gearing ratio. The gearing ratio is looking at owner's equity divided by total debt. What we're trying to understand here is what is the relationship between the owner's or investor's money and debt, in other words, borrowings that we've taken from the bank. How much money have the investors put in and how much money has been provided by the bank? Here, a generally accepted ratio would be 1:1. In other words, again, for every R2 that I have within an organization, R1 should have been provided by the owners and R1 should have been provided from borrowings from the bank. Looking at profitability ratios, in particular, we look at two ratios. The first one being the gross profit margin. Here we say gross profit divided by sales. And I want to remind you that gross profit is the profit that is achieved when we subtract our cost of sales from our sales. This is a percentage calculation, so a reminder that you would need to multiply this answer by 100 so as to get a percentage. The next one is the net profit margin. Here we are looking at the overall profit of the business, the final bottom line. Once you have paid all your operational expenses, interest and tax, and therefore we would take this net income divided by sales, again multiply by 100 to gain a percentage. We then looking at returns or yields. Here the first one, we look at a return on investment. In other words, we are trying to understand what kind of return are we getting on the assets that we've invested in this business. Remember, you've purchased machinery and built a factory so that you can run your business. Are you getting the return out of the profits from this business to justify your decision in investing in these assets? Therefore, you would look at taking your net profit after tax divided by your total assets, and again multiplying this answer by 100 to gain a percentage in terms of the return on investment. The next one, we would look at a return on equity. So yes, as the owners, we've invested money into the business. Again, we want to understand, am I getting a return that is acceptable, or should I have just taken the safe bet and put the money in the bank account and just earned whatever the prevailing interest rate is? So as a return on equity, the money that I've invested in the business, again, I would look at my net profit divided by my owner's equity, and again, that answer multiplied by 100 to gain a percentage. Lastly, one of the calculations that we can also look at is gaining an understanding of the credit terms that I've offered my customers. This we refer to as the accounts receivables days. And here what we are looking at is saying, let's take my accounts receivable balance, in other words, my debtors balance, divided by my credit sales. And this I would then multiply by 365 being the number of days in a year. And that would hopefully give me an answer around 30 days. The reason for that is that if we are providing our debtors with 30-day payment terms, then they should be paying us in 30 days. If I'm getting an answer substantially higher than 30 days, then I know I have a problem with the collection period. In other words, I'm taking too long to get the money coming back into the business, and I would need to kind of contact my debtors and inform them that they are outstanding and that they need to pay their outstanding amounts. So we spoke earlier about business management and how financial management ties back to business management. So understand that financial management provides a manner of us controlling the business by looking at financial ratios. Understanding these financial ratios will assist managers and owners of businesses make better decisions that will enable them to run their business more profitable and effective into the future. So again, if we think about profitability ratios, what we're trying to really ascertain is all this time and effort and money that we're putting into the business, is it really worthwhile? Are we yielding the kind of return that we would want to get? As I mentioned earlier, potentially we could just invest the money into the bank account and earn 6% or whatever the prevailing rate is. Looking at solvency, again, like I said, we want to understand, how do we fund our business? Are we using our own money to fund the business, or are we using debt to fund the business? Remember that with debt comes a legal obligation. A bank will only borrow you money knowing that you are going to repay them with interest. So therefore there is an operational risk in terms of you needing to make enough profits to cover those interest payments. Yes, sure, shareholders putting money into a business are expecting a dividend, a return on their investment, but there's no legal obligation like there is in a loan that you've taken with the bank. We then looked at liquidity of a business. That's also extremely important to businesses, because we want to know that we have enough physical cash in the business. This is one of the greatest challenges for businesses, especially small SMEs. And here the challenge is, am I running out of cash? So we looked at current assets in the relationship to current liabilities. And again, just a reminder, the word current means within 12 months. Can I convert these current assets, the physical bank account balance, the debtors, the inventory, can I convert these into physical cash in order to meet the short-term liabilities that I have, short-term loans, overdraft, my accounts payable, my suppliers that have provided me with credit? And then we looked at also the asset test, or sometimes it's referred to as the quick test. Here we excluded inventory. The reason for that, because there's risk associated with inventory. The harsh realities are that inventory could potentially get damaged, stolen. There's also cost associated with inventory in terms of storage cost or security costs, in terms of guarding it. And then we also looked at if we were to exclude the inventory, would I still have sufficient money to cover my current liabilities? I just want to remind you of those general rule of thumbs. The quick test or the asset test, there we're looking for a relationship of R1. For every R1 that I owe, I have R1 to pay. If I go back to the current ratio, there the relationship is 2 to 1. In other words, for every R1 that I owe somebody, I have R2 available. In other words, I could pay them R1 and still retain R1 for myself. Overall, I hope that this video has helped you in understanding how financial management ties back to business management, and that you can use financial ratios to help run your business.